Is your portfolio really sustainable? Or is it falling victim to a silent trend known as greenhushing? In this video, we'll break down what ESG means, what greenhushing is, and why it matters for your investments, even if you're not a hardcore environmentalist. Let's get into it. ESG stands for Environmental, Social, and Governance. It's a framework investors use to evaluate companies beyond just profits. Environmental means how a company impacts the planet, like carbon emissions, waste, energy use, and climate responsibility. Social is about how the company treats people, its employees, its customers, and the communities it operates in. Governance refers to leadership and accountability, how decisions are made, how transparent they are, and whether the company is ethically run. Investors use ESG to find companies that aren't just profitable today, but also sustainable and less risky in the long term. Companies with strong ESG profiles often outperform over time, especially in a world where environmental and social challenges are becoming financial risks. Now, let's talk about greenhushing, a term that's getting a lot of attention right now. Greenhushing is when companies intentionally keep quiet about their sustainability efforts, not because they aren't doing anything, but because they're afraid to talk about it. This silence is usually strategic. Companies are scared of being accused of greenwashing, exaggerating, or faking their environmental claims. They're also afraid of political backlash, especially in regions where ESG has become controversial. So instead of bragging about their sustainability goals, they say nothing at all. That might sound harmless, but for investors, it's a big deal, because it means less transparency, less data, and more uncertainty when you're trying to evaluate companies. Here's why you should care as an investor. When companies greenhush, you lose visibility into how they're preparing for future risks. A company might have major exposure to climate regulation or social instability, but if they're not talking about it, you won't know until it's too late. You might also miss out on companies doing great ESG work simply because they're staying silent. If you invest in ESG funds or strategies, this gets even trickier. Fund managers rely on public data to screen for ESG performance. When that data disappears, it's harder to know which companies actually align with the fund's goals. And if regulators discover a company is hiding ESG risks, that could mean lawsuits, fines, or a drop in share value, all of which can hit your portfolio. Greenhushing isn't just a PR strategy. It's a risk management issue for companies and for investors like you. So, how do you protect yourself? First, dig deeper. Don't rely only on ESG scores. Check annual reports, sustainability disclosures, and listen to earnings calls. Look for action, not just words, and be skeptical of silence. Second, diversify your ESG exposure. Use platforms or funds that engage with companies, not just passively invest in them. Active ownership can pressure companies to stay transparent. Third, stay informed on regulation. Governments in the U.S., Europe, and Asia are introducing laws that force companies to report ESG data. That means greenhushing may become harder, and companies hiding information could be exposed. And finally, remember this. A company saying nothing isn't always a sign of modesty. Sometimes it's a red flag. Greenhushing may be quiet, but its impact on your portfolio is loud. As an investor, you deserve transparency. Whether you're focused on climate, ethics, or just long-term growth, knowing what companies aren't saying can be just as important as what they are. If you found this helpful, give the video a like, share it with someone who's into investing, and subscribe for more insights on trends shaping the future of finance. And in the comments, let us know, have you noticed greenhushing in companies you follow? Stay informed, stay curious, and remember, silence speaks volumes.